Most investors around the world were not expecting Donald Trump to take over the Oval Office. They certainly weren't expecting the stock market to rally if he did. Delbrook Capital founder and portfolio manager Matt Zabloski was among those concerned a Trump victory would clobber stocks and positioned his fund accordingly. The Delbrook Resource Fund lost 12% in November as a result. I talked to Zabloski earlier and asked how he's repositioned himself since then.
We entered the election market neutral for the most part, uncertain exactly what was going to happen. It was the effect afterwards that I think caught most people by surprise. We adjusted our portfolio in a manner where we went longer the precious metals than we probably should have. That was a trade that did not work out, however, is beginning to come back now. We call it sort of the honeymoon effect, if you will, of the Trump period between inauguration and between the election and inauguration. So we've adjusted our portfolio now going into the inauguration. Longer precious metals, continue to be constructive on base metals. However, I think the coming seasonally of the precious metals trade is what we're seeing in the market right now, combined with the Trump effect, uncertainty as to what exactly the future holds for the U.S. and the world.
So in terms of the long-short positions, just give an overall kind of sectoral look at where you're short these days versus where you're taking long bets.
Yeah, I mean, right now our portfolio is net long precious metals. We believe that's short-term a seasonal trade that will work out well for our investors. Long-term, we're constructive. We would argue that geopolitical risks have only increased in the last 6 to 8 months between Brexit, elections, referendums, and future elections in Europe. So we're net long the precious metal space. A little bit more conservative in the base metals front. We really have to dissect down into what the base metals are. Zinc, we're still very, very constructive. We think there's near-term supply deficits that still are not priced into the market correctly. But some of the bulk commodities, I think, is where we're finding the majority of our short positions. Things like iron ore, things where, when we look at the sector, we see almost every producer producing at an economic profit at the moment. That doesn't last very long in the bulk commodity space.
So yeah, the iron ore call is because you see additional production coming on? What's the kind of horizon on that?
Absolutely. I mean, there's no shortage of iron ore deposits in the world at the moment. It's just a matter as to what the prices are that they can realize for production. As we analyze it internally right now, there are very few uneconomic iron ore deposits. That's not a good thing for prices in the long term.
On gold, cautiously optimistic?
Cautiously optimistic. Short term, there's a great trade here. Seasonally, generally golds do well, January, February, March. So we're into some long liquid names, hedged off against through some of the ETFs that are out there. I think this summer you probably have short-term headwinds from the Federal Reserve. That's not going to help. We need to look at gold, though, in terms of a global commodity. So local currency gold, Canadian dollar gold, Australian dollar gold, not just US dollar gold. But sentiment in general tends to slow down as we get into the summer. And I think the Federal Reserve may actually create quite a headwind for the market this summer.
You are looking at M&A activity. What are some of the names you think might benefit there?
Yeah, I mean, what we're looking for at the moment right now are producing single asset producing companies. Our thesis in general is that the majors have underinvested in the sector. Looking out 2 or 3 years, there's a massive production shortfall. We believe they're going to have to backfill that with some M&A. So what we're looking at are producing assets in politically safe jurisdictions, Canada, Australia, for example. And so we've begun to selectively pick away at names such as Detour Gold.
Okay. When the markets did what they did last year, it tends to be bad for active and good for passive, and we saw a lot of kind of shifting of assets as a result. You outperformed the market last year.
We did.
What were some of the bets or positions you took, and how does that compare to where you're positioned now in terms of doing better than a rising market?
Right. I mean, we in that essence last year were deep value investors. We had to be. We were hedged to a certain degree. We did do very well. We had about a positive 90% year with approximately 30% of the book sold short, so we did fairly well. Where we're looking at right now in terms of the portfolio is still identifying value. That's the secret to us. This sector has been decimated for so many years. We're now in an eighth year of a bear market for the sector.
Right.
That means that investment in the sector has basically been non-existent. So we see a huge opportunity to selectively pick off high quality assets on the long side and hedge a portfolio through a variety of different mechanisms out there.
Where are you on fixed income these days?
We're light on fixed income. We were believers in the fixed income cycle earlier this year, sort of in the February-March timeframe. We had almost a perfect culmination of events with the high-yield bond market blowing up at about the same time that the commodity cycle bottomed, January, February of 2016. So we made some great investments at that point in time. Went into some names, Teck, Cominco being one of them, or Teck, Hecla Mining being the other. Those were bonds that we were buying 60, 70 cents on the dollar. very good yield to maturity, and we felt that the market had overpriced them to the downside.